The government is offering you a deal right now. Put up to $32,500 into a traditional 401k this year if you're over 50. If you're between 60 and 63, the number is $35,750. The financial press calls these catch-up contributions. HR departments frame them as making up for lost time. And the logic sounds airtight. You have more to contribute now, so contribute more now. Simple. Except the same tax code that lets you stuff the account also forces you to empty it on a government-controlled schedule at ordinary income rates through a three-way interaction with Social Security and Medicare that can push your effective marginal tax rate above 40%. And the more aggressively you stuff the account, the harder you get hit. The people who followed the advice perfectly are often the ones who pay the most for it. This is not a fringe scenario. This is the default outcome for disciplined savers who never modeled what the money looks like when it actually comes out. So here is what I want to walk through today. There are 4 distinct mechanisms inside the standard retirement system that all work against a large pre-tax 401k balance after 50. They're not random, they are structural. They interact with each other, they compound on each other, and they were not designed with each other in mind, which is why nobody ever draws the full picture. I'm going to draw the picture, I'm going to show you the math, and at the end, I'll give you 3 specific moves, not generic advice, calibrated to this exact problem. Think of your traditional 401k as a pressure cooker. Every year you contribute, especially after 50, when the IRS allows you to pour in extra, you're adding heat and pressure to a sealed container. And yes, the food inside grows faster than it would in an open pan. Tax-deferred compounding is real. The math on that is not a lie. I'm not here to tell you the account is useless, but here's the part that gets left out of every benefit enrollment meeting. At age 73, federal law forces you to open the lid. Not when you want to, not in the year the market is up, when the government tells you to. Whatever comes out is taxed as ordinary income at whatever marginal rate applies to your full picture, not a number you calculated at age 38 during open enrollment. And the bigger the cooker, the bigger the explosion when it opens. The more you stuffed it between 50 and 65, the more pressure you built. And the explosion has a name. It has 3 names, and they all fire at once. I'll keep coming back to this image. Every time I describe a new mechanism, ask yourself, are we building wealth here, or are we building pressure? In a few minutes, I'm going to show you how a single dollar of required minimum distribution income at age 73 can actually cost you more than $1 in total combined taxes. But first, let me explain why the retirement calculator you're using, or that your financial advisor uses, is producing a number that is almost certainly wrong, not because of bad math, but because it is solving the wrong problem. Most people model retirement tax efficiency like this. I contribute to a pre-tax account at my current marginal rate, say 22%. When I retire, I'll have lower income, so I'll be in the 12% bracket. I defer the 22% tax now, pay 12% later. That's a 10-point spread captured in compound returns for 25 years. It's a clean story. The problem with it is that it treats retirement income as if it exists in a vacuum. It doesn't. Let me give you someone to think about. His name is Robert. He's 68 years old, worked 31 years, maxed his 401k for most of his career, really leaned into the catch-up contributions after 50. He retired at 66 with roughly $900,000 in his traditional pre-tax 401k. He has Social Security coming in, about $28,000 per year based on his earnings record. His mortgage is paid. His kids are through college. His monthly expenses are modest. He has modeled this carefully. He is, by every conventional measure, fine. He is, by his own calculation, comfortably in the 12% federal bracket. Robert is not in the 12% bracket. At 73, the IRS instructs Robert to begin taking required minimum distributions. Required minimum distributions are minimum amounts that U.S. tax law requires one to withdraw annually from traditional individual retirement accounts and employer-sponsored retirement plans, and to pay income tax on that withdrawal. The purpose of the RMD rules is to ensure that people do not accumulate retirement accounts, defer taxation, and leave these retirement funds as an inheritance, the government is not interested in helping you build a dynasty. It wants its tax revenue, and it wants it on its schedule. With a $900,000 balance, Robert's first required minimum distribution at 73 is roughly $34,000, calculated against IRS life expectancy tables. That $34,000 comes out as ordinary income. It hits his return the same way a paycheck would, added to his $28,000 in Social Security provisional income plus half of his Social Security itself, as the IRS formula requires, and Robert's modified adjusted gross income crosses the threshold where up to 85% of his Social Security benefits become taxable. Not a portion, 85. Social Security benefits may be tax-free, partially taxed, or up to 85% taxable, depending on other income. The IRS uses a formula called provisional income that counts not only wages or pensions, but also withdrawals from retirement accounts, interest, and even half of Social Security itself. That means a small withdrawal from an IRA or a required minimum distribution can trigger a domino effect, suddenly making more of Social Security taxable. So Robert's $34,000 distribution doesn't just get taxed at Robert's marginal rate. It also activates a lever that pulls $23,800 of his Social Security, 85% of $28,000, into taxable income, which then gets taxed again at his marginal rate. In some cases, every additional dollar withdrawn from a traditional retirement account can cause up to 85 cents of Social Security benefits to become taxable as well. For many middle-income households, this tax torpedo causes their marginal tax rate within a wide range of income to be 150% or 185% of their stated tax bracket. Many middle-income retirees can have a federal alone marginal tax rate of 40.7%. Robert thought he was in the 12% bracket. He is functioning at closer to 24 to 28% effective on each marginal distribution dollar when you account for the torpedo effect. That is roughly the same rate he was paying when he made the contributions decades ago. The arbitrage he spent 30 years building evaporated. And it evaporated precisely because he saved so well. You think the problem is that you didn't save enough. The actual problem, for a lot of people reading this scenario, is that saving everything in a single pre-tax bucket creates a tax concentration risk that doesn't appear until your early 70s, when your income is theoretically fixed, your flexibility is lowest, and you're legally required to make withdrawals whether the market is up or not. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Stay with me, because this next part changes the picture even further. And unlike the RMD torpedo, which doesn't activate until you're 73, this one is being calculated right now based on decisions you're making this year. The second mechanism is called IRMA, the Income-Related Monthly Adjustment Amount. It is the system by which Medicare charges higher earners more for the exact same coverage, and higher earner, in this context, begins at $109,000 of modified adjusted gross income for a single filer in 2026. For 2026, Medicare beneficiaries who earn over $109,000 a year and who are enrolled in Medicare Part B and or Medicare Part D pay the income-related monthly adjustment amount, which is a surcharge added to the Part B and Part D premiums. The standard Part B premium in 2026 is $202.90 per person per month. That is what your neighbor pays. With IRMA, your total can reach up to $689.90 per month, more than 3 times the base rate. The 2026 IRMA brackets impose Medicare surcharges of $1,148 to $6,936 per person when modified adjusted gross income exceeds $109,000 for a single feeler. For a married couple where both spouses are on Medicare and both land in the highest bracket, IRMA can total more than $10,000 per year in additional premiums for the exact same insurance. Now, here is the structural detail that connects this directly to your 401k balance. Most people don't find out they owe IRMA until a notice arrives in the mail based on income from 2 years ago. Because IRMA uses a 2-year look back, income decisions today affect premiums 2 years later. So, the income from your 401k distribution this year, voluntary, forced by RMD, or triggered by a Roth conversion determines your Medicare premium in 2028. You will not know the number until a letter arrives. You cannot appeal it retroactively. It is already set. And the precision of the penalty is remarkable. The threshold for each IRMAA bracket can cause a sudden increase in the monthly premium amount. If your income crosses into the next bracket by $1, your Medicare premiums can suddenly jump by over $1,000 per year. $1 of income, $1,000 of premium. That is not a smooth sliding scale. That is a cliff. And your 401k distributions are the thing most likely to push you off it. The people who understand IRMAA are spending the years between 63 and 72 managing their annual income with the precision of a surgeon, staying below threshold brackets, choreographing Roth conversions. The optimal strategy often involves front-loading Roth conversions in years 63 to 64 up to just below the IRMAA Tier 1 threshold, then reducing conversion amounts once on Medicare to manage the ongoing surcharge. The people who don't understand IRMAA are just watching their Medicare bill and thinking, there's been an error. There hasn't been an error. They stuffed the cooker too hard. Here's the part nobody draws on a whiteboard. The tax torpedo and IRMAA are separate mechanisms, but they use nearly identical inputs. Both are triggered by your modified adjusted gross income. Both are amplified by traditional 401k distributions. Both hit simultaneously after 73 when RMDs begin. And because the 2-year IRMAA look-back means your 73-year-old self is paying the price of your 71-year-old income the year your first voluntary pre-RMD withdrawals likely began, you have about a 24-month warning window that most people never use because nobody told them it was coming. Now let me show you the third trap, and this one is the one that turned me personally from a max everything pre-tax person to someone who thinks about account location as deliberately as account size. Before you turn 50, the volatility of your portfolio is essentially a non-issue across a long enough timeline. If the market dropped 46% in 2008, which it roughly did, peak to trough, and you were 35 and still contributing, that crash was effectively a discount. You bought more shares at lower prices. Your existing balance had 20 plus years to recover. The sequence of returns didn't matter much because you weren't taking money out, you were putting money in. After 50, that math inverts entirely. The risk is greatest in the 5 years before and the first 10 years after retirement, a period sometimes called the retirement red zone. During this window, your portfolio balance is at or near its peak, and losses have the longest time to compound against you. Sequence of returns risk focuses on the timing of market drops and how early losses in retirement can reshape your entire income picture. You can average the same annualized returns as another retiree and still end up with very different results simply because your bad years arrived at the wrong time. Here's the illustration that makes this visceral. Consider 2 retirees, both starting with $1 million. Both average 5% annually over 20 years. Both withdraw $50,000 per year. The only difference is when the losses occur. Same average return, but a $665,000 difference in ending balance. And the bad sequence portfolio was in serious distress by year 5. $665,000 evaporated. Not because either retiree did anything wrong, not because their average return was different, because the bad years showed up first for one of them. Research by Wade Pfau estimates that approximately 77% of a portfolio's final retirement outcome can be explained by the returns of just the first 10 years. 77% of everything determined in the first decade. You've been thinking about 30-year averages. The system cares about what happens on the first day you stop being a contributor and start being a withdrawer. Now here is the connection that almost nobody makes explicit. The larger your pre-tax 401k balance at retirement, the more dollars are maximally exposed to sequence of returns risk. And unlike a taxable brokerage account, you cannot do tax loss harvesting inside a 401k. You cannot strategically choose to liquidate during a down year to create a capital loss deduction. The pre-tax account is sealed. It's the pressure cooker again. And when the market is down 20% and you still need income to live, you are selling at the worst time with zero tax strategy tools available at ordinary income rates. Meanwhile, the investor who split their savings between a Roth account and a taxable brokerage has something you do not: optionality. In a bad market year, the Roth investor takes income from the Roth. No taxable income, no Social Security trigger, no IRMA impact, no ordinary income at the moment of maximum portfolio vulnerability. They let the pre-tax account sit, compressed and wounded, and give it room to recover. They sell nothing at a loss. They control the narrative. They built a kitchen with multiple burners. You built one enormous pressure cooker. Let me tell you about a scenario a financial planner documented publicly. I'll change the name to call him Dale. Dale was 52, mid-level manager at a manufacturing company, making about $140,000 a year. Careful saver. Maxed his traditional 401k every year since his mid-30s. By 52, he had roughly $480,000 in the pre-tax account. Not a dollar of Roth. Almost no taxable brokerage account. His entire retirement savings infrastructure was one very large, very sealed container. He'd been told his whole career by every source he trusted, max the pre-tax first, always. At 54, his company was acquired. He was laid off during the integration. This is not a rare outcome. More than half of all workers age 50 and older lost their long-held jobs because they were laid off or otherwise forced to leave involuntarily, according to research from the Urban Institute. The study suggests that many older workers encounter unexpected financial setbacks during the period when saving and planning for retirement is most critical. And separately, about 5 years separates what Americans plan and what actually happens. Non-retirees target 66. Most actually retire at 61. Dale found a contract role at about 60% of his prior salary. He kept contributing modestly. By 60, his 401k had grown to roughly $740,000. He felt good. It looked like a success story from the outside. What Dale didn't model, at 73, his projected RMD on that account, assuming continued compounding, would push him into the second IRMA Medicare surcharge bracket virtually every year of retirement. That surcharge, applied across a 20-year retirement, accumulates somewhere between $50,000 and $90,000 in premiums, paid above the standard rate, for the same coverage, for the exact same doctor. His neighbor, same age, same income history, but with a split account strategy, pays the base rate. Dale's perfectly executed single bucket strategy cost him the equivalent of a car payment in perpetuity for the rest of his life, with zero additional goods or services received in exchange. The penalty for discipline. The 401k, for context, was created by a provision of the Revenue Act of 1978. The original intent was to allow executives to defer bonuses and profit sharing. It was not designed from the ground up as the primary retirement vehicle for 160 million American workers. The IRMAA surcharge was added in 2003. Required minimum distribution rules have been modified through the Tax Cuts and Jobs Act and Secure 2.0 over the last decade. These systems did not evolve together. They grew up in separate legislative sessions, passed by different Congresses, adjusted at different moments. They interact the way software patches interact with legacy code, technically compatible, practically ruinous for anyone who fell through the gaps between updates. Now, you might think, fine, so I shouldn't max the traditional 401k after 50. But what about the fees? Isn't the tax deduction still worth something? Let me address that directly, because there's a fourth mechanism here that amplifies everything. If you have $100,000 in your 401k and fees are 0.5%, your account balance will grow to $227,000 at retirement. If fees are 1.5%, your account balance will grow to only $163,000. The 1% difference in fees reduces your account balance at retirement by 28%. 28% from 1 percentage point. Gone, not in a crash, not in a bad year, but slowly, silently, in every single year that your money sits in the account. Now, the industry average is better than it used to be. Average equity mutual fund expense ratios incurred by 401k plan participants have fallen 66%, a 50 basis point decline from 0.76% in 2000 to 0.26% in 2024. That is a genuine improvement. The fee wars have been good for savers in large plans, but size matters enormously here. The average investment expense for 401k plans with 25 participants and $250,000 in total assets is 1.37% of assets. A $5 million plan has average total costs of 1.0 to 8%, including advisor compensation. If you work at a mid-sized company, not a Fortune 500, not a tiny startup, you are almost certainly paying between 0.7 and 1.2% in total fees. That is meaningfully higher than the headline numbers the industry publishes. A 1% fee on a $200,000 401k held for 30 years at 7% gross return costs you roughly $170,000 in loss compounding. That is not a rounding error. That is a year or more of retirement income, quietly extracted by a system you didn't design, can't exit, and probably can't fully see on your statement because administrators don't send bills every year. They don't itemize fees on statements. Fees are shown through the plan's reduced net returns. Now, stack the four mechanisms. The tax torpedo on Social Security creates an effective marginal rate of 40% or more on RMD income. IRMA creates a Medicare premium cliff that can cost $10,000 or more per year for a married couple. Sequence of returns risk is maximized when your balance is its largest and least flexible. And fees silently reduce your balance by 28% over 30 years across a 1 percentage point differential. Each of these is proportional to the size of your pre-tax balance. Every extra dollar you stuff into the traditional 401k after the employer match makes all four of these worse simultaneously. Here's the part that sounds almost heretical, given 30 years of financial industry messaging. For many people over 50 with substantial existing pre-tax balances, the marginal dollar after the employer match does not belong in the traditional 401k. It belongs in a Roth account, a taxable brokerage, or some combination of both, depending on your current income, projected retirement income, and IRMA trajectory. The case for Roth is not that Roth returns are higher. Returns are identical. The market doesn't know which pocket your money is in. The case for Roth is that Roth distributions are invisible to the tax torpedo, invisible to IRMA, carry no RMD obligation. As of January 2024, Roth 401ks no longer have required minimum distributions. You are not required to withdraw RMDs from a Roth 401k account and produce zero ordinary income at the moment of maximum vulnerability in the retirement red zone. Starting in 2026, if you earned over $150,000 in FICA wages in the prior year, your age 50 plus catch-up contributions to your employer-sponsored retirement plan must be Roth contributions. The government is essentially mandating the right move for high earners. If you're above that threshold, the IRS is making the decision for you. If you're below it, you're being given the same option voluntarily. Either way, the logic points in the same direction. The case for the taxable brokerage account is similarly underrated. Every financial advisor in the 90s told you it was inferior because there's no deduction on the way in. That framing treats all tax rates as equivalent, which they are not. Long-term capital gains rates for most middle-income earners are 15% or 0%, not the 22 to 33% effective rate that 401k distributions carry in the torpedo zone. The brokerage account also gives you tax loss harvesting, complete liquidity, no forced distributions, no income that counts toward provisional income for Social Security taxation, and no IRMA impact. The trade-off paying taxes on contributions now at your current rate increasingly looks like the cheaper option when you've modeled the four-way trap on the other side. Here is a piece of the average situation across the people this video is aimed at. The average 401k balance for Americans ages 55 to 64 is $272,600, but the median, which represents the typical worker, is just $84,700. For workers under 35, the average is $49,900, and the median is only $18,800. These gaps reflect extreme wealth concentration. A small number of workers with million-dollar balances pull the average far above what most people actually have saved. $84,700 at 55. If your balance is well above the median, you are in the territory where all four mechanisms begin to bite. If you're near the median, getting the employer match and building a modest Roth or brokerage position alongside it is still the more versatile strategy. The financial press will tell you Path A maximum pre-tax contribution every year is always better because the account is bigger. The financial press does not model tax torpedoes. It does not model IRMAA cliffs. It does not model the retirement red zone. It models account balance as if account balance and after-tax spending power are the same number, and they increasingly are not. An advisor at a financial services firm, I don't need to name, charges you 1% per year of your assets to explain about half of this, then adds their fee to your IRMAA calculation. I am not capable of doing this with a straight face. Let me make this concrete with specific numbers. Call her Sandra, 51 years old, earns $95,000 per year, has $220,000 in her traditional 401k. No Roth, minimal taxable brokerage. Path A, Sandra follows the conventional script. Maximum catch-up contributions every year, $32,500 in 2026, roughly tracking with the IRS adjustments through 65. 14 years, assuming 7% annual return, her balance at 65, approximately $1,200,000. She retires, she feels accomplished. At 73, her first RMD is approximately $46,000. With Social Security of about $24,000 per year based on her earnings history, her provisional income is high enough that 85% of her Social Security benefits are fully taxable. Her MAGI lands her in the first IRMAA tier, adding roughly $1,148 annually in Medicare surcharges. Her effective marginal tax rate on that $46,000 distribution, accounting for the torpedo interaction, runs between 28 and 33%. Every year, the RMD grows slightly because the base account is still compounding through her early 70s, despite withdrawals. Path B. Sandra contributes exactly enough to get her full employer match, approximately $2,850 per year. Then, she redirects all remaining available savings into a Roth 401k, which her employer offers and for which her income qualifies. Any surplus beyond the Roth cap goes into a taxable brokerage. After 14 years at the same 7% return, Sandra's combined Roth and brokerage balance is lower in raw dollars, let's say $900,000 total, because she was not capturing the same tax deferral. On paper, she has less, but at retirement, 0 RMDs from her Roth. IRMAA calculation is substantially lower because Roth withdrawals generate no MAGI. Her Social Security is not in the torpedo zone. She pays 0 federal tax on qualified Roth withdrawals and 15% on long-term brokerage gains versus the 28 to 33% effective rate Path A produces at the torpedo peak. Her income is controlled, flexible, and bracket aware in a way that Path A structurally forbids. The gap between Path A and Path B is not the balance. It is after-tax spending power, which is the only number that buys groceries. Sandra in Path B has less in the account. She has more in her checking account every year for the rest of her life. Let me give you the 3 things to actually do with this. Not general guidance, specific moves calibrated to this exact problem. First, project your RMD today. Use your current pre-tax 401k balance. Assume 7% annual growth and calculate what your first required minimum distribution would be at age 73 using the IRS Uniform Lifetime Table. It's free on irs.gov. Then add that number to your estimated Social Security income and look up the IRMAA brackets for that year. If you land above $109,000 as a single filer or $218,000 as a joint filer, Those are the 2026 thresholds. You have an IRMA problem in development and about a decade to address it through Roth conversions. If you land below those thresholds, but in the Social Security provisional income zone, which starts at $25,000 for single filers and $32,000 for joint filers, you have a torpedo problem. Either way, you need the number before you can address it. This exercise takes 20 minutes and costs nothing. Second, if your plan offers a Roth 401k, use it for catch-up contributions at minimum. The standard base contribution, up to $24,500, involves a genuine tax calculation that depends on your current rate versus your expected retirement rate. The catch-up portion, the extra $8,000 per year after 50, is where the trap is most concentrated because it's the marginal dollar going into the largest, most leveraged end of the pressure cooker. A Roth 401k on that marginal contribution captures the same market return with none of the RMD, none of the torpedo trigger, and none of the IRMA input. It is not a tax avoidance scheme. It is a tax timing and bracket management decision that your 68-year-old self will thank you for in ways your 52-year-old self cannot fully appreciate. Third, stop treating your taxable brokerage account as a consolation prize. It is not an inferior retirement vehicle. It is a different vehicle with different properties. And after 50, several of those properties are specifically better than the traditional 401k for incremental retirement savings. No forced distributions, no ordinary income rates, no provisional income impact, no IRMA input, long-term capital gains rates that for the income ranges most of the people watching this will occupy in retirement are 15%, not 22 to 33. The trade-off is that contributions come from after-tax dollars. Given everything I've described about the cost structure on the other side, that is increasingly a trade worth taking. The frame I'd offer you in all of this is simple. It's 3 piles: Roth money, taxable brokerage money, and pre-tax money. The pre-tax pile is extremely useful at the right size. The RMD torpedo is optimized to detonate at about the size most high earners hit by following conventional advice. Your job between now and retirement is to calibrate how large each pile is relative to your projected retirement income, not to maximize any single one. Here's the part that nobody discusses when they talk about catch-up contributions. About 5 years separates what Americans plan and what actually happens. Non-retirees target 66. Most retire at 61. In 76% of those cases, circumstances outside their control drove the decision. A health problem, a layoff, or a family member who needed care. The plan you built for 66 does not serve you if you exit at 61 with most of your wealth locked in a pre-tax account that doesn't open until 73, an IRMA calculation you can no longer control, and a Roth balance too small to carry the gap. The most likely retirement scenario is not the optimal one. It is the forced one. Build the system for the world as it is, not the career trajectory as you've imagined it. And one more number before I close out. At ages 55 to 64, the 90th percentile 401k balance is $904,200 more than 10 times the median. A small number of maximum contributing, long tenured, high earner accounts pull the mean to $272,600, even though more than half of that age group has under $84,700. If you're in or approaching the upper tier, if you've been diligently maxing for years and your balance is already substantial, you are the primary target of the mechanism I've described today. The conventional advice was built for the median. The conventional advice was not stress tested against the 4-trap system that activates when you actually built real savings. Lazy investing built more fortune than crypto memes. The 401k brochure tells you to fill the cooker. The tax code waits 20 years, then opens the lid at the worst possible time and charges you for every degree of pressure you built. You don't own the pot, you manage it. Manage it accordingly.